Question 1. Which of the following best describes a life with period certain annuity payout option? A. The annuitant receives payments for life, and if they pass away before a specified period ends, payments continue to a beneficiary until the period ends. B. The annuitant receives payments only for a specified period, regardless of their lifespan. C. The annuitant receives payments for life, and after they pass away, all remaining funds are returned to the original premium payer. D. The annuitant receives payments for life, and payments stop immediately upon their death, with no further benefits paid. Answer A. The annuitant receives payments for life, and if they pass away before a specified period ends, payments continue to a beneficiary until the period ends. Explanation: a life with period certain annuity combines lifetime income with a guarantee period. If the annuitant passes away before the end of the specified period, e.g. 10 or 20 years, payments continue to a named beneficiary until the end of that period. This payout option provides the annuitant with lifetime payments and assures their heirs of a minimum payout duration. Option B is incorrect because a period-only annuity does not offer lifetime payments. Option C incorrectly describes an installment refund annuity where the annuitant or beneficiaries are guaranteed to receive back at least the total premium paid. Option D describes a life-only or pure life annuity, which has no additional guarantees after the annuitant's death. Oregon annuity regulations emphasize that clear disclosure of each option's benefits and limitations is crucial to help clients make informed decisions. Question 2. Scenario-based. Marcus, who is 55, recently purchased a deferred annuity and is considering making a partial withdrawal to cover unexpected expenses. What tax and penalty implications should he be aware of if he proceeds with this withdrawal? A. Withdrawals will be tax-free up to his initial contribution amount, but any earnings withdrawn would incur ordinary income tax and an additional 10% early withdrawal penalty. B. He can withdraw up to $10,000 without penalty, but earnings will be subject to capital gains tax. C. Withdrawals are tax-free if he reinvests the amount within 60 days, but an early withdrawal penalty of 10% applies if he does not. D. Withdrawals will incur ordinary income tax on the earnings portion, but there will be no penalty since Marcus is over 55. Answer A. Withdrawals will be tax-free up to his initial contribution amount, but any earnings withdrawn will incur ordinary income tax and an additional 10% early withdrawal penalty. Explanation: in a deferred annuity, withdrawals are typically subject to LIFO, last in, first out taxation, meaning the earnings are considered withdrawn first and are taxed as ordinary income. Since Marcus is under age 591, or any earnings withdrawn will also incur a 10% early withdrawal penalty under IRS rules. Unless an exemption applies, his initial contributions can be withdrawn tax-free as they were funded with after-tax dollars, but the earnings portion is subject to both income tax and the penalty. Option B is incorrect, as there is no blanket $10,000 exemption on early withdrawals from an annuity. Option C inaccurately refers to a rollover rule that does not apply to non-qualified annuities. Option D is incorrect because the 10% early withdrawal penalty applies to earnings unless the annuitant is over 591, regardless of being over age 55. Oregon guidelines and federal tax laws emphasize the importance of understanding tax treatment to avoid unintended penalties on early withdrawals. Question 3. Which of the following statements correctly describes the tax treatment of death benefits in a non-qualified annuity? A. Death benefits are tax-free to beneficiaries regardless of the contract's accumulated value. B. The beneficiary only pays taxes on the death benefit if annuitant was under age 591 at the time of death. C. Death benefits are subject to income tax on the earnings portion, but the initial premium contributions are tax-free. D. Beneficiaries pay taxes on the entire death benefit amount as ordinary income. Correct answer: C. Death benefits are subject to income tax on the earnings portion, but the initial premium contributions are tax-free. Explanation: in a non-qualified annuity, the death benefits earnings portion is subject to income tax for the beneficiary. The contributions made with after-tax dollars, principal, are not taxed again, while only the earnings accrued within the contract are taxed as ordinary income. Option A is incorrect because annuity death benefits are not generally tax-free. Only life insurance policies offer tax-free death benefits. Option B misrepresents the tax rule, as the age of the annuitant at death does not impact the taxability of death benefits in annuities. Option D is incorrect because only the earnings portion is taxed, not the entire death benefit amount. Oregon regulations and federal tax guidelines stress the importance of understanding these tax implications, particularly in estate planning and beneficiary designations. Question 4. Which of the following best describes in indexed annuities a participation rate? A. The maximum return the annuity can achieve, typically set by the insurance company annually. B. The percentage of the index's gain that will be credited to the annuity based on the performance of the selected index. C. The rate at which the annuity guarantees a minimum return on the premium invested. D. The amount by which the annuity's credited interest rate will exceed the performance of the chosen index. Answer: B. The percentage of the index's gain that will be credited to the annuity based on the performance of the selected index. Explanation: the participation rate in an indexed annuity determines the percentage of the index's gain that is credited to the annuity. For example, if the participation rate is 80% and the index gains 10%, the annuity is credited with an 8% gain, 10% x 80%. Option A is incorrect because it describes a cap, not a participation rate. Option C is incorrect as it describes a guaranteed minimum rate, a separate feature. Option D is incorrect because participation rate does not exceed the index gain. Oregon annuity regulations require insurers to disclose participation rates to ensure clients understand potential earnings and limitations. Question 5. Scenario-based. Sarah, age 60, has a variable annuity and is evaluating her sub-accounts. She wants to maximize her growth potential but is concerned about market volatility. What strategy should she consider to balance her risk and growth objectives? They allocate her funds primarily to a fixed account for stable returns without market exposure. B. Select a diversified mix of equity and bond sub-accounts to reduce volatility while allowing for growth. C. Concentrate her investment in high-growth equity sub-accounts to maximize potential returns. D. Move all funds to money market account to minimize risk exposure entirely. Answer: B. Select a diversified mix of equity and bond sub-accounts to reduce volatility while allowing for growth. Explanation: Sarah's best strategy to balance growth and risk would be a diversified allocation in both equity and bond sub-accounts. This approach provides growth potential from equities and some stability from bonds, helping manage market volatility. Option A is too conservative and limits growth potential, while option C increases exposure to market risk. Option D minimizes risk but does not meet her growth objective. Oregon suitability guidelines emphasize the importance of aligning annuity investment choices with the client's risk tolerance and financial goals. Question 6. Taxation and rules. Which statement about 1035 exchanges of annuities is correct? A. A 1035 exchange allows an annuity contract to be exchanged for another annuity contract without any immediate tax consequences. B. A 1035 exchange permits tax-free exchanges of annuities, life insurance, or mutual funds. C. A 1035 exchange allows an annuity to be exchanged for any type of retirement investment vehicle. D. A 1035 exchange incurs a tax penalty if the owner is under age 591. Answer: A. A 1035 exchange allows an annuity contract to be exchanged for another annuity contract without any immediate tax consequences. Explanation: Section 1035 of the IRS Code allows a policyholder to exchange one annuity for another without recognizing any gain or loss, thereby deferring tax consequences. Option B is incorrect because mutual funds do not qualify under 1035 exchange rules. Option C is incorrect as the exchange must remain within similar financial instruments, e.g., annuity to annuity. Option D is incorrect because there is no age-related penalty for the exchange itself, although standard withdrawal penalties may apply under different conditions. Oregon regulations on 1035 exchanges emphasize tax deferral advantages and the need to ensure client suitability. Question 7. Which of the following is a key difference between fixed and variable annuities? A. Fixed annuities have a guaranteed minimum interest rate, while variable annuities returns fluctuate with investment performance. B. Variable annuities offer tax-free growth, while fixed annuities do not. C. Fixed annuities require larger minimum premiums compared to variable annuities. D. Variable annuities are insured by the FDIC, while fixed annuities are. Answer: A. Fixed annuities have a guaranteed minimum interest rate, while variable annuities returns fluctuate with investment performance. Explanation: Fixed annuities provide a guaranteed minimum interest rate, offering stability and predictability. In contrast, variable annuities are tied to market performance, so their value can fluctuate. Option B is incorrect, as both types allow tax-deferred growth, not tax-free growth. Option C is incorrect as there is no standard requirement that fixed annuities require larger premiums. Option D is incorrect. Neither fixed nor variable annuities are FDIC insured. Oregon regulations require clear disclosures about annuity types to help clients choose products that meet their needs. Question 8. For a client interested in a joint and survivor annuity, which payout scenario is most accurate? A. The annuity pays the same amount to the surviving spouse regardless of who dies first. B. The annuity stops payments once either spouse passes away. C. The annuity continues to make payments to the surviving spouse, usually at a reduced percentage, until their death. D. The annuity provides a one-time lump sum to the surviving spouse upon the annuitant's death. Answer C. The annuity continues to make payments to the surviving spouse, usually at a reduced percentage, until their death. Explanation: in a joint and survivor annuity, payments continue to the surviving spouse after the first annuitant's death, often at a reduced rate, e.g., 50% or 75% of the original payment. Option A is incorrect as the payment amount is typically reduced. Option B misstates the survivor feature. Option D inaccurately describes a lump sum, which is not typical in joint and survivor annuities. Oregon annuity rules require agents to disclose payout structures, particularly when addressing survivor benefits. Question 9. Which of the following is required by the Oregon Department of Consumer and Business Service (DCBS) to protect consumers purchasing annuities? A. A 30-day review period for annuity contracts. B. Full disclosure of all fees, charges, and potential surrender penalties. C. Automatic approval of all annuity contracts without underwriting. D. Waiving all surrender charges for contracts held over 5 years. Answer B. Full disclosure of all fees, charges, and potential surrender penalties. Explanation: Oregon's DCBS requires insurers to disclose all fees, charges, and potential surrender penalties to protect consumers. This transparency enables clients to make informed choices about annuity products. Option A is incorrect because the review period varies by state and product. Option C misrepresents the approval process, as underwriting may be required based on the product. Option D is incorrect because surrender charges are determined by the contract terms, not automatically waived based on time held. Oregon's consumer protection laws prioritize transparency to help clients understand all annuity costs. Question 10. A guaranteed minimum withdrawal debit in an annuity contract ensures that A. The annuitant can withdraw a fixed percentage of the account value annually even if the account value drops to zero. B. The annuitant's withdrawals are limited to the interest earned on the contract. C. The annuitant can withdraw an unlimited amount annually without reducing the principal. D. The annuitant receives a guaranteed return based solely on the initial premium amount, regardless of market performance. Answer A. The annuitant can withdraw a fixed percentage of the account value annually, even if the account value drops to zero. Explanation: a GMWB rider allows the annuitant to withdraw a set percentage, typically 5–7% of the account value each year, even if the account balance falls to zero. This provides income security regardless of market performance. Option B is incorrect as withdrawals are not limited to interest alone. Option C is incorrect as the GMWB does not allow unlimited withdrawals without affecting principal. Option D is incorrect because the return is not based solely on the initial premium. It may be adjusted for withdrawals. Oregon annuity rules require detailed rider disclosures to help clients understand benefits and limitations. Question 11. Jim, age 58, is considering an immediate annuity to fund his retirement but wants to ensure he has liquidity for emergencies. Which of the following options should Jim discuss with his financial advisor? A. A fixed indexed annuity with no surrender charges. B. An annuity with a guaranteed lifetime withdrawal benefit rider. C. A deferred annuity with a 10-year payout schedule. D. An immediate annuity with a cash refund option. Correct answer: D. An immediate annuity with a cash refund option. Explanation: the cash refund option in an immediate annuity can offer Jim some liquidity by returning the remaining principal to his beneficiaries if he passes away early. Option A may lack liquidity if it has penalties for early withdrawals. Option B provides lifetime income but does not necessarily offer emergency liquidity. Option C is a deferred payout and does not meet his immediate income needs. Question 12. Tax implications when funds are withdrawn from a non-qualified annuity. How are they typically taxed? A. Withdrawals are taxed as ordinary income on the interest portion only. B. The full amount is taxed as capital gains. C. The initial contributions are tax deductible. D. Withdrawals are always tax-free after age 591. Answer A. Withdrawals are taxed as ordinary income on the interest portion only. Explanation. Withdrawals from a non-qualified annuity are taxed on a last-in, first-out basis, meaning interest earnings are taxed as ordinary income, while principal is not taxed since it was funded with after-tax dollars. Options B and C are incorrect. Annuities are not taxed as capital gains, and contributions are not tax deductible. Question 13. When determining if an annuity is suitable for a client, which of the following is a key factor to consider? A. The client's favorite type of investments. B. The client's short-term income needs. C. The client's financial objectives and risk tolerance. D. The cost of the annuity compared to other annuities. Answer C. The client's financial objectives and risk tolerance. Explanation. A client's financial objectives and risk tolerance are crucial in determining annuity suitability, as these affect how well the product aligns with their long-term goals. Option B is less relevant since annuities are typically long-term products. Option D is important but secondary to the client's needs and objectives. Question 14. Product features. A two-tiered annuity typically provides A. Different interest rates based on how the annuity is accessed. B. Guaranteed tax-free withdrawals. C. Unlimited withdrawals without penalties. D. Enhanced interest if funded with IRA contributions. Answer A. Different interest rates based on how the annuity is accessed. Explanation. A two-tiered annuity often has one interest rate for annuitization and another, typically lower, rate if funds are withdrawn as a lump sum. Options B, C, and D are not features of two-tiered annuities. Question 15. Which of the following accurately describes a surrender charge? A. A penalty for annuitizing an annuity contract early. B. A fee applied to withdrawals within a specified period after purchase. C. A tax levied on annuity withdrawals. D. A fixed fee charged annually for holding an annuity. Answer B. A fee applied to withdrawals within a specified period after purchase. Explanation. A surrender charge is applied if funds are withdrawn within a certain period, usually the first several years of the contract. Options A, C, and D misrepresent the nature of surrender charges. Question 16. Marissa has a deferred annuity but is concerned about market downturns reducing her income. Which of the following features should she consider? A. A fixed annuity option within her contract. B. A variable annuity with no guarantees. C. A guaranteed lifetime withdrawal benefit rider. D. A market value adjustment feature. Answer C. A guaranteed lifetime withdrawal benefit rider. Explanation. A GLWB rider can help protect Marissa's income regardless of market performance. Option A may offer stability but does not guarantee lifetime withdrawals. Option B lacks guarantees, and D primarily adjusts for interest rate changes rather than market risk. Question 17. Suitability and financial goals. In which scenario would a deferred annuity be most suitable? A. A retiree seeking immediate monthly income. B. A young investor looking for a tax-deferred growth vehicle. C. An investor seeking high liquidity in an investment. D. A senior with only short-term savings needs. Answer B. A young investor looking for a tax-deferred growth vehicle. Explanation. Deferred annuities are best for individuals seeking long-term tax-deferred growth. Option A would benefit from an immediate annuity. Options C and D are less suited to annuities due to liquidity constraints and the long-term nature of annuity products. Question 18. Taxation. How are annuity payments taxed when received from a non-qualified immediate annuity? A. Entirely as ordinary income. B. Partially as a return of principal and partially as interest. C. Entirely tax-free if the owner is over age 590 onward. D. As capital gains based on investment performance. Answer B. Partially as a return of principal and partially as interest. Explanation. Payments from a non-qualified immediate annuity are partially taxable. The portion representing return of principal is tax-free, while the interest portion is taxed as ordinary income. Options A, C, and D mistake the tax treatment of immediate annuity payments. Question 19. Regulations. Which disclosure is mandatory for annuity sales under Oregon regulations? A. Disclosure of the product's average rate of return for the past decade. B. Full disclosure of all fees, charges, and potential penalties. C. The insurer's average claim payout time. D. The agent's commission rate. Answer B. Full disclosure of all fees, charges, and potential penalties. Explanation. Oregon regulations require that annuity sales include clear disclosures about all fees, charges, and penalties so clients can make informed decisions. Options A. C, and D are not required by regulation, although disclosure of fees and charges is a critical consumer protection measure. Question 20. Investment options. Which of the following is a benefit of a fixed indexed annuity? A. Guaranteed market-like returns. B. Potential for growth linked to an index without direct market risk. C. Complete liquidity for the investor. D. High returns without any caps. Answer B. Potential for growth linked to an index without direct market risk. Explanation. Fixed indexed annuities offer growth potential based on index performance but protect principal from market downturns. Option A is incorrect as returns are not guaranteed. Option C is incorrect as liquidity is often limited by surrender charges. Option D is incorrect because returns are typically subject to caps or participation rates. Question 21. Types of annuities. Which of the following best describes a longevity annuity? A. An annuity that starts payments immediately upon purchase. B. A deferred annuity designed to begin payments at an advanced stage, such as 85. C. An annuity with payments guaranteed only for a specified term. D. An annuity tied directly to stock market performance. Answer B. A deferred annuity designed to begin payments at an advanced stage, such as 85. Explanation. A longevity annuity, also known as an advanced life deferred annuity, is designed to provide income in the later years of retirement. Starting at a specific age like 85, it helps guard against the risk of outliving one's savings. Question 22. Product features. An annuity contract's free look period allows a policyholder to A. Adjust the interest rate before the contract begins. B. Cancel the annuity contract without surrender charges within a specific time frame. C. Withdraw up to 10% of the funds without penalty. D. Change beneficiaries with no restrictions. Answer B. Cancel the annuity contract without surrender charges within a specific time frame. Explanation. The free look period gives the policyholder a set number of days, usually 10 to 30, to review the annuity contract and cancel without incurring any charges. This period is a consumer protection measure. Question 23. Application-based. Sarah, age 70, is concerned about leaving a legacy and has chosen an annuity with a death benefit feature. What will this feature provide? A. Monthly income for her beneficiaries. B. A lump sum payment to her beneficiaries upon her death. C. A guaranteed payout to her beneficiaries for a minimum period. D. Annual increases in her annuity payments. Answer B. A lump sum payment to her beneficiaries upon her death. Explanation. A death benefit in an annuity provides a lump sum payment to beneficiaries if the policyholder passes away, helping her to leave a legacy. Options A, C, and D do not accurately describe the death benefit feature. Question 24. Investment risks in a variable annuity. The value of the annuity may decrease due to A. Fluctuations in the stock and bond markets. B. Changes in interest rates alone. C. The insurance company's financial performance. D. The withdrawal rate of other policyholders. And so, A. Fluctuations in the stock and bond markets. Explanation. The value of a variable annuity depends on the performance of the underlying investments in the stock and bond markets, which can lead to a decrease in value during market downturns. Options B, C, and D are not correct explanations for this risk. Question 25. Guaranteed riders. A guaranteed lifetime withdrawal benny-eligible rider on an annuity provides which of the following? A. A guaranteed payout that lasts for the contract's term. B. Guaranteed access to the full principal at any time. C. Lifetime income payments regardless of the account's investment performance. D. A lump sum payout if the annuity holder becomes terminally ill. Answer C. Lifetime income payments regardless of the account's investment performance. Explanation. A GLWB rider provides a lifetime income stream even if the account value is depleted, ensuring that the policyholder receives a guaranteed income. Options A, B, and D do not accurately describe the GLWB rider. Question 26. Fee structures. The mortality and expense risk fee in an annuity contract covers A. The insurance company's cost of managing investment risk and administrative expenses. B. Any potential losses due to market downturns. C. Penalties for early withdrawals. D. Fees for adding additional beneficiaries. Answer A. The insurance company's cost of managing investment risk and administrative expenses. Explanation: the mortality and expense risk fee is typically charged to cover risks the insurer assumes, such as mortality risk and administrative costs. It is part of the annuity's cost structure. Options B, C, and D do not accurately represent this fee. Question 27. Income options. Which annuity payout option provides income for the life of the annuitant with no benefits to beneficiaries after death? A. Life-only annuity. B. Joint and survivor annuity. C. Life annuity with period certain. D. Installment refund annuity. Answer: A. Life-only annuity. Explanation: a life-only annuity pays the annuitant a lifetime income ending with the annuitant's death and leaving no payments for beneficiaries. Options B, C, and D provide different structures that may include benefits for beneficiaries. Question 28. Financial suitability. Why might an annuity be unsuitable for a young investor with high liquidity needs? A. Annuities are tax-free investments. B. Annuities typically have surrender charges and limit liquidity. C. Annuities have high rates of return. D. Annuities are only meant for high-income earners. Answer: B. Annuities typically have surrender charges and limit liquidity. Explanation: annuities are long-term financial products, often with penalties for early withdrawal, surrender charges, making them less suitable for young investors needing access to funds. Options A, C, and D are inaccurate descriptions of annuity characteristics. Question 29. Withdrawal penalties. What is the primary reason for the 10% IRS penalty on annuity withdrawals before age 590 onward? A. To encourage long-term retirement savings. B. To recover administrative costs for the insurer. C. To increase annuity product sales. D. To match the penalty structure of traditional savings accounts. Answer: A. To encourage long-term retirement savings. Explanation: the 10% early withdrawal penalty is intended to promote annuities as a long-term savings vehicle by discouraging early withdrawals. Options B, C, and D do not accurately explain the purpose of the IRS penalty. Question 30. Surrender charges. In an annuity with a 7-year surrender charge period, what would likely happen if a withdrawal is made in the 5th year? A. No fees are applied as it is beyond the 4th year. B. A surrender charge is applied as it is within the 7-year period. C. The withdrawal is tax-free. D. The insurer increases the contract's interest rate. Answer: B. A surrender charge is applied as it is within the 7-year period. Explanation: a withdrawal during the surrender charge period, such as in the 5th year of a 7-year period, typically incurs a fee. The other options incorrectly describe the consequences of a withdrawal during this period.